The second most asked question we get is infinite banking real? Yes, you can stack and pull out cash in a life insurance policy like we're stacking and pulling out this Chesapeake Bay trash, but it's not all quite as smooth as social media would have you think. So overfunding a universal life insurance plan to be able to take out cash and use that tax-free is a great way to self-bank yourself for other investments or ventures. One of the biggest benefits for this is that you don't have to be approved by any lender, and most importantly, the cash you pull out can still accrue interest as if you never took it out in the first place. But for one, you have to understand that life insurance is not an investment, it is a service. So any amount of premium you put in is not going to immediately reflect in policy value or cash value. It will be deducted by some sort of cost to be covered, also known as cost of insurance. Now, in a good index or variable universal life plan, you will start to accrue compound interest pretty quickly. Depending on the rate of funding, you can very quickly end up making a profit on that plan. But because it's a life insurance plan first, you actually have to be approved to get such a policy. Now, when it comes to getting approved for life insurance, there's a requirement that has to be satisfied called suitability. Companies legally can't just issue life insurance plans on people without first confirming that coverage is needed. Taking out a life insurance plan to self-bank is not going to meet suitability requirements. Now, this hurdle isn't too hard to cross, so let's go ahead and say we already issued you a plan and you're overfunding and ready to self-bank. When you take that cash out as a policy loan, which is the only way this works, many of the finfluencers out there will say it doesn't matter that that loan is going to be assessed an interest rate, because the interest rate due on the cash you took out will be eclipsed by the interest rate you get on the remaining policy value. And this is all very true. Your policy value will continue to accrue interest as if you never took that money out. And that interest will likely exceed any loan interest due on the cash you took out. But what they don't often discuss is that cost of insurance charge we talked about earlier doesn't stay flat. As you get older, your costs to be covered get higher with your age. And these rising costs of insurance plus your loan interest due can and very likely will diminish your cash value to the point where your policy will lapse if you do not immediately start repaying the loan for the cash you took out. If the loaned out cash amount from your policy exceeds the amount of premium you put in, which if it's a self-banking plan, it should, and then that policy ceases to exist, which means that cash is no longer tied to an active life insurance plan, IRS will come calling for income taxes due on that money. It's only tax-free for as long as it's tied to an active life insurance policy. These are some of the details you won't hear in a minute clip of somebody trying to sell you a policy saying you can get rich off life insurance.